Understanding liquidity traps, causes, effects, and solutions. A liquidity trap is a term commonly used in economic discussions to describe a scenario where interest rates are extremely low, yet consumers and investors choose to hoard cash rather than spend or invest. This behavior effectively undermines monetary policy efforts aimed at stimulating economic growth. The concept was popularized by economist John Maynard Keynes, who noted that in such situations, monetary policymakers could find themselves powerless to influence economic activity, even when conventional tools like lowering interest rates and increasing the money supply are employed. Definition and characteristics of a liquidity trap. The liquidity trap phenomenon becomes more pronounced and the following characteristics are evident. Very low interest rates hover around zero, discouraging conventional borrowing and lending. Economic recession, the economy experiences stagnation and slow growth. High personal savings levels, individuals and businesses prefer to keep cash on hand rather than invest in securities or spend on goods and services. Low inflation or deflation, price levels remain stagnant or decline due to reduced demand. Ineffective expansionary monetary policy, efforts by policymakers to spur growth through conventional means yield minimal results. Why do liquidity traps occur? Several factors contribute to the emergence of a liquidity trap. 1. Deflation. When prices of goods and services drop, consumers may anticipate future opportunities to purchase items at an even lower cost. This mindset can lead to an extended period of cash hoarding. 2. Balance sheet recession. When consumers and businesses prioritize debt repayment over spending or borrowing due to a fear of default, the economy can stagnate. 3. Low demand from investors. A prevalent lack of confidence in the market can lead to minimal investor interest, meaning lower interest rates fail to inspire new investments. 4. Reluctance to lend. After episodes of financial crises, banks may tighten lending standards, leading to a scenario where potential borrowers struggle to access credit even at low interest rates. Economic implications of a liquidity trap. The presence of a liquidity trap can have far-reaching effects on the broader economy. Stagnation. Prolonged cash hoarding leads to diminished demand for goods and services, further weakening economic growth. Struggling markets. With fewer buyers for bonds and securities, yields rise, compounding issues for prospective borrowers. Increased unemployment. As businesses pull back on expenses and investment in response to declining demand, job losses can follow. Diluted monetary policy effectiveness. Traditional economic levers may become ineffective when low rates are insufficient to stimulate spending. Navigating out of a liquidity trap. While escaping a liquidity trap can be challenging, several approaches may help re-energize economic activity. Interest rate adjustments. Although risky, raising interest rates could prompt individuals to seek better investment opportunities. Increased government spending. Public investment in infrastructure or social programs could stimulate demand and generate job growth. Quantitative easing. QE. Central banks can engage in QE to expand the money supply by purchasing financial assets, encouraging lending and spending, even in a low-rate environment. Negative interest rate policies. NIRP. Some regions have experimented with negative rates to incentivize borrowing and discourage cash hoarding, effectively charging banks for holding excessive reserves. Real-world examples. The concept of liquidity traps gained prominence in historical contexts. Japan's lost decade. Following asset bubbles in the late 1980s, Japan experienced persistent stagnation, low interest rates, and deflation, maintaining a liquidity trap through the 1990s and into the 2000s. As of 2022, Japan's central bank continues to operate with negative interest rates. Post-2008 financial crisis, economists pointed to liquidity trap characteristics in the wake of the Great Recession. Low interest rates and increased cash hoarding characterized an economy slow to recover despite robust central bank interventions. Is the U.S. currently in a liquidity trap? As of 2024, the U.S. economy is facing significant inflation and rising interest rates, which counter the typical signs of a liquidity trap. The U.S. witnessed brief liquidity trap-like conditions at the onset of the COVID-19 pandemic and during the Great Recession, but robust fiscal measures and quantitative easing quickly shifted the economic trajectory. Conclusion: liquidity traps represent a complex conundrum in economic policy and practice. They demonstrate the limits of traditional monetary policy in addressing economic stagnation, especially when consumers and businesses opt for caution over risk, choosing to hoard cash rather than invest or spend. Recognizing the signs and implications of liquidity traps is vital for policymakers aiming to enhance their tools in stimulating growth and fostering a healthy economy.